two conflicting voices in the White House. Tough to see where economic policy goes now.
Yeah, I mean, I think it was, markets took a lot of comfort in the fact that Gary Cohn was there, and they viewed him as a voice for the markets and kind of a balancing force against the tariff contingency within the White House. So I think markets will look for ways to worry about this.
Are you worried about a trade war ultimately here?
Not really. It still seems like a pretty tail risk to us, but that said, once you've started the ball rolling, it's hard to know how far it rolls.
It feeds into a narrative, though, and a nervousness that the markets feel right now. You obviously have done a great deal of work on volatility, the greater moderation, as you call it, the suppression of macro-level volatility. Where are we right now?
Yeah, well, the point of the greater moderation observation is just to say that if you look at the macro data itself, whether it's the volatility of employment, GDP, inflation, there really hasn't been any drama in the data. The drama really has been in the markets. So I'm thinking of, for example, the VIX spike earlier in February, as well as, the latest news out of DC. So I think the catalyst or the drama really is coming from places other than the macro data at the moment.
You describe yourself as reluctantly bullish on equities at this moment, based on valuations relative to where rates are particularly.
Yeah, I think, the reluctance comes from the fact that valuations are high, and everybody knows that.
Yes.
But the reason you have to go there anyway is because if you look at those macro fundamentals, the volatility is not there. It looks like we're on pace for a very strong year of growth in 2018, both from the U.S. and globally. So it's hard to see what derails markets in that environment.
What does?
Well, it could be some of the things we've seen already, right? I think, one of my big concerns around something like the VIX crash, which I would argue is the sort of thing we've seen now in lots of major markets, right? We've seen flash crashes in rates, in equities, now in VIX, we've seen them in FX. So I think as long as those flash crashes are happening at a time when the macro backdrop is solid and sound, markets don't worry about it. But the question that hasn't been answered, right, and is not tested is what happens if we get a flash crash at a time when the market is already worrying about the macro environment.
You also point out quantitative tightening, and we're talking about potentially the ECB and Japan here, and investors are already nervous. We've seen that this year, kind of irrespective of the macro data where core inflation is pretty anchored in those regions. What about this?
Yeah, I mean, I think it's another example of market psychology, right? I don't get worried about QT from a fundamental perspective. It's not even a tightening, right? Globally, it's just a deceleration of the pace of asset accumulation by central banks. Having said that, in our conference this morning, we took a poll in the room and I asked for a show of hands. How many people in here think QE is the main reason asset prices have rallied as much as they have in this expansion? And almost every hand goes up. So it's a pillar of belief in the market that QE was a big deal. So I think the withdrawal of QE is kind of like taking away the security blanket. It's not quite clear how that will go psychologically, but so far I think central banks have managed that communication pretty successfully.